Economic bubbles have fascinated and devastated societies throughout history. From the 17th century Dutch obsession with tulips to the internet-fueled frenzy of the dot-com era, these speculative booms showcase the dangers of irrational exuberance and the market's susceptibility to hype and speculation. The Tulip Mania, 1637. Flowers for fortunes. Tulip Mania occurred in the Netherlands during the Dutch Golden Age, around 1634 to 1637. This period was characterized by rapid economic and cultural growth, where trade and commerce flourished. Thanks to the Dutch East India Company, tulips were initially introduced to Europe from Turkey, quickly becoming a status symbol for the wealthy in the Netherlands. The flower's rarity and exotic appearance, especially the broken tulips with multicolored patterns, sparked a trading frenzy. Tulips were not just flowers. They were a statement of wealth and sophistication. At the peak of the bubble, prices for some tulip varieties, such as the Semper Augustus, reached astronomical levels, selling for prices equivalent to a luxurious house in Amsterdam. These rare bulbs were traded in a market that saw individuals from all walks of life, including merchants, craftsmen, and even farmers, rushing to participate in the lucrative tulip trade. The tulip fever, a market gone wild. By 1636, a futures market had emerged, allowing speculators to trade tulip bulbs for future delivery. This market structure fueled further speculation, enabling people to buy and sell tulips they never intended to plant or even see. The frenzy reached its peak in early 1637, with some bulbs trading for 10 times the annual income of a skilled worker. It wasn't just the elites who were caught in the fever. Even the common folk sold their belongings to buy tulip bulbs, hoping to turn a quick profit. The mania was so intense that one sailor mistakenly ate a tulip bulb worth 2,500 guilders, mistaking it for an onion. Such incidents highlight the absurdity of the market at its peak. The tulip market was not merely about horticulture. It had transformed into a speculative asset market, where bulbs were exchanged as if they were precious metals or valuable commodities. The sudden burst. Tulips lose their shine. In February 1637, the bubble burst abruptly. Tulip prices plummeted by 95% almost overnight, leaving many holding worthless bulbs. The market collapse sent shockwaves through the Dutch economy, leading to financial ruin for speculators and widespread societal disdain for speculative greed. The crash did not cause a wider economic crisis, but it was a wake-up call for the risks of unchecked speculation. People who had invested their life savings found themselves bankrupt, while the once glamorous tulip bulbs were now worth less than onions. The Dutch government considered intervening to stabilize the market, but in the end, they decided against it, allowing the market to find its natural equilibrium. This hands-off approach allowed the bubble to serve as an economic lesson in market dynamics and the consequences of irrational exuberance. The dot-com bubble, 2000. A digital déjà vu. Fast forward to the late 1990s and early 2000s, and we see a different but eerily similar bubble. The dot-com era. Fueled by the internet boom, technology companies' stock prices skyrocketed despite many having no viable business models or profitability. Investors poured money into companies with .com in their names, driven by the belief that the internet would revolutionize every aspect of business and society. By March 2000, the Nasdaq index peaked at 5,132.52, only to crash sharply, leading to the dot-com crash. In the aftermath, thousands of internet companies went bankrupt, and the Nasdaq plummeted to around 1,100 by October 2002. This crash wiped out trillions of dollars in market value and left many investors in financial ruin. The dot-com bubble served as a painful reminder that even revolutionary technologies are not immune to speculative excess. Parallels and lessons learned. Both Tulip Mania and the dot-com bubble shared key characteristics: speculative trading, irrational exuberance, and the greater fool theory, where investors buy overpriced assets hoping to sell them to a greater fool. In both instances, the frenzied trading was driven not by the intrinsic value of the assets, but by the belief that prices would continue to rise indefinitely. Both manias inflated asset prices far beyond intrinsic value, leading to inevitable market corrections. The lesson is clear: speculative manias, driven by fear of missing out, can drive markets to irrational heights, resulting in devastating crashes. Investors in both bubbles were drawn in by the promise of quick wealth, often ignoring warning signs and rational analysis. The aftermath of each crash left a sobering legacy, teaching future generations the importance of due diligence, market fundamentals, and the risks of herd behavior. The impact on markets and society. The bursting of these bubbles had significant repercussions. The Tulip Mania caused localized economic damage, but had little long-term impact on the broader Dutch economy. However, it did lead to a change in societal attitudes towards speculation and financial risk. Conversely, the dot-com crash led to a global economic downturn and increased scrutiny of financial markets. The crash forced companies to rethink their business models, emphasizing profitability and sustainable growth over mere market presence. It also led to regulatory reforms aimed at improving market transparency and protecting investors. While the dot-com bubble caused more widespread economic pain, it also paved the way for the maturation of the internet sector, ultimately giving rise to tech giants like Amazon and Google, which learned from the mistakes of their predecessors. The psychological drivers, fear and greed. Both bubbles illustrate the powerful psychological forces at play in markets. Tulip Mania was driven by irrational exuberance and the belief in ever-rising prices. Investors were caught up in a collective euphoria, ignoring the basic economic principle that demand cannot infinitely outstrip supply. In the dot-com bubble, the allure of the internet's potential led investors to disregard fundamental valuations. Fear of missing out on the next big thing pushed people to invest in companies with little more than a business plan and a website. Media and contemporary accounts amplified the euphoria in both cases, drawing in the public and fueling the bubble. This herd behavior is a testament to the cyclical nature of human psychology, where greed and fear drive market dynamics more than rational analysis. It serves as a reminder that markets are not always driven by logic, but are often swayed by emotions. Market dynamics, the boom and bust cycle. Economic bubbles follow a common pattern: the stealth phase, awareness phase, mania phase, and the inevitable crash. The stealth phase is when the asset is introduced, drawing attention from early adopters. In both Tulip Mania and the dot-com bubble, the boom was characterized by rapid price escalation and a speculative frenzy. The awareness phase is when institutional investors start taking notice, followed by the mania phase, where the general public jumps in, pushing prices to unsustainable levels. The crash occurs when the market realizes that asset prices are disconnected from reality, leading to a sell-off and a return to mean prices. This cycle underscores the importance of understanding market fundamentals and the risks of speculative fervor. Recognizing these phases can help investors avoid getting caught in the hype and make more informed decisions. The aftermath and regulation. After Tulip Mania, the Dutch economy faced a period of stagnation, and public sentiment turned against speculation. It laid the groundwork for the Dutch becoming pioneers in financial markets, introducing concepts like short selling and futures trading. However, they also learned the importance of market regulation to prevent speculative excesses. The dot-com bubble's aftermath led to increased market regulation and a shift towards more sustainable business models. The Sarbanes-Oxley Act, enacted in 2002, aimed to enhance corporate responsibility and financial disclosure. While both events serve as cautionary tales, they also highlight the market's capacity for innovation and adaptation. Despite the crashes, both eras contributed to the advancement of financial markets and the evolution of modern economic systems. And there you have it, an intriguing journey through some of history's most infamous economic bubbles. If you found this video fascinating, make sure to give this video a thumbs up and don't forget to subscribe to our channel for more engaging content. Also, hit that notification bell so you never miss an update. Thanks for watching, and we'll see you in the next video.